All right, this is being recorded, and one thing I say at the very beginning of all of these webinars is please watch it again, especially if you're new to options trading and or this particular strategy. I'm going to be talking about a lot of rules and things that I follow, so it will help you to watch it through very soon after. It'll make it sink into your long-term memory. I'm going to be going through some different rules that I don't think most people talk about in regards to options and how to defend this type of strategy and what to do if it starts going against you. Thanks, Trevor. I'm doing well. Thank you. This is going to be on short strangles. So this is going to be an undefined risk strategy, but I will talk about how you can make it IRA appropriate, just a way to get around the rules of naked short strategies in an IRA. And you can pretty much do that around any naked short strategy. It doesn't decrease your risk, but it will make it appropriate for the rule makers. Anyway, a couple things to go over. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical market analysis. I actually started trading in college when I was trying to get my psychology degree and started playing around with the stock market and decided to switch it over to finance. And then upon graduating, I decided to pack my bags, move to Chicago, and start working on the floor of the Chicago Board of Trade. And I did it like most people. I started out as a runner, running paper, and moved myself up to owning my own badge and trading on the floor there. So I'm not here to tell you that I'm going to make you rich or a millionaire, but I am helping you try to take control of your finances, because if somebody else is managing your money, I was just talking to somebody the other day that the government's trying to change what these different funds can charge people on commission. So now everybody's saying everything's commission free. Well, they're loading it up with the fees that are embedded inside of those, and those are increasing by like 50%. So to try and get your yield is going to be very difficult. And if you just take control of your finances, do little things like educate yourself. I mean, the best thing you can do is take care of that little gray matter in between your ears, and you guys can do just as well as these guys on Wall Street. How do you get the recording, Bill? It should be sent out to you in an email shortly after this is done. It takes me a while to convert it, and then I post it and we send it out. All right. And I've traded in most markets throughout my career, even from the Chicago Board of Trade. I've traded everything from stocks, financial futures, commodities, currencies, and options on all of these products in all market conditions. As a matter of fact, one little tidbit that I got, I've talked with somebody the other day, and if you believe it or not, corn and soybeans are fruits. They're not vegetables. It's a little tidbit from a farmer's point of view. Anyway, this basically is a disclaimer saying any opinions, news, research, and analysis or other information provided by ProTrader Strategies and or associate companies is for general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies that we're talking about. And the reason why, you guys, like, I know a lot of people out there say, hey, you know, this is a great time to put on this particular underlying with this strategy. Well, at the end of the day, it's not fiduciary responsibility to tell somebody to do something. You really have to look at your own risk parameters. And for order for me to do that, I would need to know what's in your portfolio already. I would need to know what your risk parameters are before I could ever even tell you whether or not it was appropriate for you. So at the end of the day, it's really do your own homework, and please remember that past performance of any trading system or methodology is not necessarily indicative of future results. One thing you can do is follow me on Twitter at Wolfman's blog, or follow us at ProTrader Strat. One thing about following me on Twitter, we're firing up for earnings season, and I talk about what underlyings I find appropriate for that particular earnings day. And again, you need to look at your own risk parameters and see if it's appropriate for you. But I also don't really throw out what the strikes are, because if you watch these webinars and stuff like that, you know exactly where I'm going with those strikes. So I'm not trying to throw it out for everybody else, but I'm kind of trying to give a hint to some of my my people that are taking these or watching these webinars and stuff like that, to give them a heads up as to what I'm doing without telling everybody else in the world. So keep that in mind. You can check that out at Wolfman's blog. And we're going to be talking about how to trade strangles to generate income, because this is really important, especially if the market we've seen lately. Yeah, it's been up 100 points, it's been down 100 points, we've been trading sideways, and we've been in a bull market for quite a long time. But you can still use these strategies in this type of scenario in order to generate a little bit more income, lower the basis on your overall portfolio, and that will ultimately make your portfolio much more robust when you go to cash out, if you will. And like I said, this is going to be on the short strangle. Some of the keys to success with this are picking the right strike. And this is a market neutral strategy. So this is going to be something where we're looking for it to trend sideways. We don't want a big up move. We don't want a big down move. It's okay if it starts trending sideways to slightly higher, as long as we don't get a big move outside of our short strikes. I will talk about it when we pull up the screen as to how to defend that, because, you know, face it, we're going to have strategies. Despite the fact that we are trying to play the probabilities, we are going to have some of these actually go against us, and that is what is important, is how we defend that, how we stay mechanical, and that is going to be the key to success. I talk about it all the time. I spend maybe 10-15% of my time on the winners, and I spend about 80% of my time on the losers and trying to manage those. So and stay mechanical, turn those into winners, and I'll show you how to do that. If you watch my daily market commentaries, I go through that. I go through all of that stuff. When something goes bad, how to defend that, how to stay mechanical, and how to increase your probabilities of success. So picking the right strikes. With this one, we're going to be looking at the 16 delta. And why do I pick the 16 delta? Because it's a 1 standard deviation move away. And if you look at this bell curve, most of the time, 68% of the time, the market is going to stay within this range. So only 16% of the time will it trade outside of that. So we're trying to increase our probabilities of success by picking that 1 standard deviation move. And what does that correlate to? Well, it correlates to the probability of being outside of that. And if you add up all of these, it comes up to very close to 16. And 16% chance of being out of the money is the probability, or is the delta. So that's how we come up with that 16 delta. So we're going to be coming up with something very close to that as our starting point. And then we're going to want to pick the right duration. Because we're selling this option strategy, we want to take advantage of theta. And theta is duration. Theta is time. So we're going to try and take advantage of this slope. And if you've watched many of my webinars, you know I always show this, because it is a great representation of what happens to your premiums as the closer we get to expiration. So the best time I like to really put on these is somewhere between 45 and 35 days. We're right around that 35 days. So I try and pick what is closest to around 35 days, or 40 days, let's call it. So as soon as it starts getting into like 38, 28 days, I'm going to be probably looking at the ones that are closer to 48 or something like that. So I'm going to default to a little bit longer duration to allow this to happen, but it's not to say that you couldn't take advantage of it with like 28 days and really take advantage of that theta decay. The only issue is you have to get closer to the market, generally speaking, when that happens. And the other side of the coin is when it's an earnings trade and I'm using this strategy, I'm usually going in really close. I'm not usually going this far out for the earnings, just as a side note. Why not the 14 days? Because theta will come out faster. Trevor, that's a great point. Some people do like to use those 14 days or the weeklies in that regard. But again, I like to get a little bit further away from where the underlying is trading in order to implement this strategy, because it's a little bit easier to be mechanical and defensive if something goes wrong. When you get that close to expiration, it makes it a lot more difficult to manage some of your risks. But if you really like to do it around those 14 days, then that's fine as far as I'm concerned. I do use some of the ones that are closer to expiration, but generally speaking, that would be only around earnings for the most part. And picking the right environment simply comes down to, we want to implement this when we have the underlying IV percent above 50. And I'll go into what IV percent is in detail. But for ETFs, and since we're really right in the thick of earnings season right now, we'll probably be looking at more ETFs than we are underlyings, because the underlyings that have high implied volatility right now are going to have earnings. And we don't want to really implement this strategy in a situation where we have earnings, 20 some days away, because we're not going to get volatility to contract for us. The closer we get to that earnings event, volatility is going to expand on us. And if volatility expands on us during that time, it's going to actually increase our premiums. Okay, so we don't want that to happen. We would like to see the volatility come out, and that's probably not going to happen with a earnings event down the road. Now, it's not to say that if you wanted to trade this around an earnings event, then I would wait until if the earnings came out after the close on a particular day, I would implement this strategy in the second half of the day after, with 2 hours maybe or less time in the day to really capture those probabilities. Because if you can imagine, during the day, you could see some volatility happen on that. And if you implemented it early on in the day or a couple of days before, you could see $1 or $2 move in the underlying, and that's going to throw off your probabilities for that event. So I like to implement it as close to the end of the day and then take advantage of that volatility contraction. All right, so the right environment, we want high implied volatility around an underlying of 50% or more, unless it's an ETF. And if it's an ETF, then I am going to look at something with 30 IV percent or more. And the reason why for an ETF my rule is a little bit lower, because an ETF has a multitude of underlyings embedded in there. So those volatilities, it's going to be much less volatile on any given day. So I move it a little bit lower for the ETFs because it's a multitude of underlyings within that. It's kind of a portfolio of them. With some, Trevor's asking, with some IVs, are you hoping that IV will go higher or lower? With IV, as soon as we implement this strategy, we are looking for IV to go lower. We do not want, on selling a short strangle, IV to go higher, because it will increase those premiums. And why, Ken's asking, why not use an iron condor instead for risk management? Not worth the cost. The reason why I like the iron condor, Keith or Ken, but one of the things with the iron condor is, in order to collect the amount of premium I want to collect, you have to go closer to the markets. And I've done webinars on the iron condors, and their rules are a little bit different with the strangle, because it is a more risky strategy. That's why I'm picking that 16 delta and getting a little further away. And it's a lot easier to defend a strangle when it starts to go wrong than really it is with a iron condor a lot of times. And TJ's asking, don't like the long strangle. I'm going to be doing the long strangle webinar next week, so you can watch that it is not one of my favorite ones. Short Strangle, Iron Condors are some of my favorite strategies for sure. But, you know, long any option is not something I really like to do. It's usually to try and stay active. I don't like paying debits for anything because the probabilities are against you when you're buying strategies. All right, I'm picking the right underlying. This is really important, you guys. A lot of times I do these webinars and people come with these off-the-wall underlyings that, you know, maybe it's something that they really know very well, but the problem is if you have to give up more than, like, you know, 25 cents or something like that for the bid ask, that's eating into your yield. That's eating into your profit. And if you have to do that consistently, you're going to be hurt for it when the going gets rough. If, you know, you need to get out of this and the market's getting a little wanky, the bid ask is going to go from 25 cents to maybe 75 cents in those underlines that a lot of people aren't participating in because they immediately go to the ones with liquidity first to try and manage their risk. So I have a rule of thumb with picking the right underlying. If it is $100 or less, I'm looking to have it be less than 10 cents wide on the bid ask. That would be, you know, 90 cents at $1 for a particular strike. So 10 cents wide on an underlying that is $100 or less. And when it gets up to like $200, I'd like to see it be inside of 15 cents really. I don't really like to look at underlyings when they get really wide, unless you get up to, like, of course, the Chipotle's. There's a lot of participation in Chipotle. There's a lot of participation in Priceline and things like that, and that rule gets a little wanky there. And there's other ways to look at the right underlying for participation. That's look at the volume and open interest. One of the easiest way is to look at the bid ask and see how tight those markets are, but the other thing is look if there's any volume or open interest. And if there's no open interest, then there is going to be a day of reckoning when you try to get out, because you're going to have to be searching for that counterparty. What if you do long SPX Strangle on day of expiration? That sounds like a really risky strategy. You have to have a major move in order to buy a strangle and have it move. And I would rather play the probabilities the other way, where you know, 70% of the time it's not going to test me, rather than trying to pick a strangle and hope that I can try and flip those probabilities in my favor. All right, and knowing your exit strategy before entering the trade. And this is important, you guys, for any strategy you have. Now, with the strangle, I generally look at taking, short strangle, I look at taking 50% of my max profit. Sometimes I'll look 30 to 50% of my max profit. And the reason behind that is because it's not worth it for me, especially if it's only been 2 weeks and I've gotten 50% of my max profit, to have that trade go all the way to expiration. Once we get into that slope in the last 10 days, gamma starts increasing, which really affects the premiums. So I would like to get out before I start having gamma risk involved in this strategy. And that's why I'm looking at like 30 to 50% of my max profit. It also moves the probabilities into my favor. I take that profit and move it on to another high probability trade. I don't have to risk it anymore. It's going to probably take you another 20 some odd days to get that other 50% of your max profit. I'd rather move it on to something else. I thought I saw a question pop up there. So this is another rule, a guideline that I like to follow. Like I said, I'm not going out to 35 days unless I have to, but 50% of my max profit I'm looking at, and I found that, you know, within 25 days you should usually be able to get to that 50-55% of your max profit. But the thing with this chart that you can like write down, put a sticky note up on your computer, is if within 5 days I'm at 15% of my max profit, I'm probably looking to cover that strategy. 10 days, within 10 days, I'm at 25% of my max profit, I'm probably looking to cover that trade. The reason why is you're beating the probabilities here, and if you can beat the probabilities anytime, it's not worth it for that other, nickel or let's say we'll probably be looking at $1 for this particular one, take 50 cents. It's not worth it to go out the next 15 or so days to collect the rest of that premium. There's high probability trades out there all the time. It's better just to close it off and move on. Which strategy would help me with gamma or buy gamma? A strategy to do that would be buying the at the money calls or puts close to expiration, because gamma, as soon as it happens, will increase. And when I pull that up, I'll show you a little bit more about that. And that would be on the long calls, long put spreads. And I've done webinars on those too. All right, so real quickly, the max profit on this, anytime you're selling an option strategy, collecting a premium, you're going to have a max profit of that premium you received, obviously minus your commissions. And then your max loss, because we have two wings on this, one's a put and one's a call, we have two max loss potentials on this. And you can't have both because the market can't split and go both ways at any given time, right? So the market's either going to go up and we're going to have our max loss there, or the profit or the underlying goes down. But our max loss, in a sense, is unlimited, especially to the upside. To the downside, it's to go to zero. We're not going to wait it out that long, but it is important for you to understand what your risks are involved with this type of strategy. So our loss to the upper end is going to be when the underlying price is greater than the call strike plus that premium. So in a situation where, let's say, the underlying is a 50, trading at 50, and we have like the 55 calls on, let's say, and we did this strategy totally for $1. We shorted the 55 calls, shorted the 45 puts. Soon as the underlying is trading above $56, so 56.01, that's when we start to see our loss happen. Same thing to the downside. If we had on the 45 puts minus the premium, so 45 puts minus that $1, as soon as the underlying is trading at 43.99, that's when our loss starts coming into play. And on the break-even side, the break-even is that equivalent. So in my example of the 45 strikes for the calls, and we collected $1 at the onset of this, as soon as it's trading $46, that's our break-even. And when it's trading $44 to the put side on those 45 put strikes, that's when our break-even is to the downside. Now this is important right here because this is where we start getting defensive on that strategy. And how do we get defensive on this? If the underlying at the beginning, on the onset of this was trading at 50, and we did the 55s and the 45s, as soon as the underlying trades to 44, which is my break even, I'm going to roll these calls down. And it's dependent on what your thinking is with this. If it happens really fast, then I might move this down to a turn it into a straddle, which is the 44 calls and the 44 puts. Usually I'm going to try and roll this down and still have a strangle, but a very tight one, and maybe collect another $1 for that call that I'm rolling down to. That's my target. So we're going to try and collect about $1 in the beginning, and then if we have to defend it, we're going down to collect another $1 as soon as it hits our break even. So that extra $1 from rolling down and or rolling up, if it was testing our upper end, gives us another $1 of break even to the higher side. So when you're rolling, you add that in to the overall total premiums you've collected, and that changes your break even. So that's how we're going to defend this. And I'll talk about this, and even talked about this with my GDXJ, how I've had to defend that strangle and roll it down. But by doing that, even though it's $2 below where my short puts are, I've collected enough premium that I've moved my break even from 39 to 38, and it's trading just above that 38 right now. So I actually even tried to get a little bit more aggressive today and roll it down yet again, but I never got filled on it. But you know, it's always trying to stay mechanical on it. All right, so let's get into the platform. So this is usually where I talk about, let's try and make this open back and forth. I think it makes it a little bit more fun for everybody and interesting. Throw out some stocks that you guys like on a daily basis, and we'll try and build this strategy around one of those. Keep in mind, just about everything with high implied volatility is going to have earnings. So even if you have some ETFs, throw those out there as well, and we'll look into those. All right. So the first one I've seen is SPY. So let's look at SPY. IBM has high implied volatility, but I believe IBM has some earnings coming up. So I don't think IBM is going to be a good one. Let me just check because it's up here. So yeah, IBM actually has earnings on the 17th, which I believe is like Monday or something, Monday or Tuesday, isn't it? Monday. So is it after the close? Oh, you're going to freeze up on me? Come on. All right, so let's skip over it. So Monday. So this would be one where I would go to the options for that earnings event. So if it came out Monday after the close, then I would implement this on Monday. All right, so back to SPY. So SPY we're going to look at, and SPY we can already see it has low implied volatility percent. One thing I talk about with implied volatility percent, when we had these big moves down, that increases the volatility of SPY. So some people like to look back 6 months. When we're looking at the platform, this goes back to 1 year on the implied volatility. It's pretty close. 25, you know, if you really wanted to implement this strategy around it, you know, you could bend that 30%, you know, SPY is an ETF, so 30% would be my rule on that. I'd like to see it a little bit higher. But another thing to do is you could look back 6 months and see what the implied volatility percent is just for 6 months, since they're saying it's 25, and we want to discount this noise here that, you know, and or like there's a black swan event, which is like something that almost never happens. If that were to have happened, you know, that's probably the probabilities of a black swan event happening anytime soon is much smaller. But what we could do to figure out the implied volatility percent for the last 6 months, let's say, we'd take this high as our high rather than the platforms taking this as our high. So we could look at our current implied volatility is 15.5. So you take the 15.5 and you subtract it by the low, which is, let's just, I'm going to have to ballpark it, 10. So minus 10. So we got 5.5, let's just say. And then we're going to divide it by the high, which is 25, and the low. So 5 divided by 15 makes that 33%. So in that regard, then we've gotten our implied volatility above it. It's kind of a bit of a hack to do that, but it is safe to say that, you know, you could see where that just happened to be an outlier, and you could even go back and time to see if that was really an outlier. 1 year, 3 weeks, something like that. And you can see that it isn't such an outlier, especially that's the big moves there. But if that were to work out there, what the way to come up with the implied volatility percent is the current IV minus the low IV, and then you divide that sum by the high IV minus the low IV. That's how you come up with IV percent. So, and a lot of people only like to look out 6 months. So if you were to only look out 6 months, that would make that within that range. So we're going to look at the 35 days here on SPX, and you can see I've got on a long put spread. But if we were going to look at it for this particular strategy, we're going to look at the 16 delta, so the 201s, and then the 16 delta to the upside is the 220s. So there's a bit of skew to the downside, obviously, because it's trading 13, so it's 12 to the downside and only about, what did we say, 20, only, so 7 to the upside. So almost half to the upside, plus those premiums are juicy down there. A lot of people expecting this to move to the downside, which pumps up the premium. So we would look at selling these 201s, and you can also look at you know, your Fibonacci's and things like that, you know, being 219 the high. So we could look at that as well and say that our 17 delta is, our 17 delta strike of the 220 is safe from that new high, and then do that. So we would collect $1.74 on this. Now the next thing to do is to know what your break even is, right? So to the upside it would be when it's trading 221.74, and then to the downside it's when it's trading 199.26. I do that math right? So that's our break even to the downside. Now in that, so if the market was to trade down there and start to test our break even or hit, you know, some people like to do it as soon as it touches their strike. One thing to keep in mind, the delta is the probability that it will be out of the money at expiration in 35 days by 1 penny, okay? But the probability of this being tested is twice that, so there's a 32% chance the market will come down here and just touch it and then come back up again. Same thing to the upside, to touch it and then come back down again. So that's why I like to go to the break even, because then it's kind of like, okay, the writing on the wall, this is actually, yeah. Well, it is the yeah, you're right. I'm sorry. I may have said that. The probability of, yes, it is the probability of being in the money by 1 penny. I look at it as it's the probability, yeah, it's the probability of being in the money. Thank you for correcting me on that. It is the probability of being in the money by 1 penny. So I look at it as the 2 times the probability of being in the money is 32. So that means, or to be tested, I should say. So the market comes down, tests that, and then bounces away. So keep that in mind. The delta times 2 is the probability of just being tested on that strike. That's a floor trader hack for you. But that's why I like to go and pick the break even to defend this. And then I'm going to look to try and roll this down to collect another $1 or so to create another strangle that's really tight in the case that it comes back up and starts trading back through and the probabilities start working out. I can still get that. If it continues to kind of trade sideways down here, then I'm going to, you know, with a few days to go, roll that down into a strangle, or sorry, from a strangle to a straddle, and then pin it right on there. But I'm looking to collect about another $1 or so as I roll down. Okay, so that's how we're going to try and defend that if it starts going bad. And you can imagine if it was, you know, trading at 199, the ones that we would be able to collect something on is going to be, if those puts were in the money by 2 cents, we'd probably be able to collect, you know, another $1.33 in this regard, because if they were, you know, $2 in the money, it would probably be closer to $1 with data decay and everything else. So that's where I'm coming up with that ballpark of trying to collect another $1. All right, so that's the idea, to try and increase your probabilities. Roll it down, collect some more premium. That lowers your probability again by another $1. So in this regard, when I said it was 199.26, it would be 198.26 then if we collected another $1. Lowered our break even. Right? And then it also gives you one more chance to do it. Yes, I have been known to invert this, where if it starts really going bad, to even roll it down further again and invert it to try and you know, staff the bleeding a little bit. So if you get a bit of a rebound, you've locked in a loss, keep in mind, but you've also decreased your losses. And that's why I look at that. It's all right, when you have to go inverted, sometimes you have to do that. You're locking in a loss, but you're locking in a lower loss than what you would possibly have had before. To defend, you would get out of the bad side and roll it down to what delta? It's usually going to be, I'm looking at collecting $1. So it is going to be about, generally speaking, when that goes into the money, it's going to be about a 36 delta. And that's an approximation. That's just kind of usually where the math comes out. Because we can imagine if that was $2 in, it would be right about a 36 delta when it is all said and done. That makes sense? Do you care about IV versus historic volatility to qualify for good opportunity? Keith, I do look at it, but it's not something that I, Ken. I do look at that, but it's not a major determining factor for me. Some people do look at it when implied volatility percent is above historical volatility. That's when you have a tendency to sell premium. Yes, that is something to look at. And or if it's if IV is below historical volatility, that's the time to be buying volatility. I usually just look at it on a percentage point basis and go with that. But yeah, I do have a tendency to look at that every once in a while, just as a bit of more of a confirmation than anything. So that's how I would set that one up. Another one was XLE. So let's look at XLE. Let me delete that one. So XLE, let's just see what the IV percent is on it. It's 14. And so you saw how far away we were with SPY. It is a bigger product. It's twice as big. It's going to be hard to do a comparison on it. And I mean, I would think this is a good product to trade, but since it's so low, we're going to be pretty tight. I mean, it's a $4 move for the most part. And, you know, it's about $4 to the upside, so that's pretty even. The other thing I'd like to do is collect at least $1 for these if at all possible. So I think I would discount this one just because the implied volatility percent is pretty low. So you could go back to this and say, well, you know, you talked about this being a discounted area. I'm only going to look back 6 months. We could do that as well. Just not seeing the premiums in there right now. But let's look at it just to, for argument's sake, 21.99. Let's call it 22 is the current. The low IV during this time frame is about 18. Let's just call it 18 for math purposes. So 22 minus the 18, we've got ourselves 4. Whoops, I divided. So 4, we know it's 4. 22 minus 18 is 4. And then 31 and a half minus that 18. So just to keep it consistent, 31 and a half minus that 18 is what? 12? No, 13 and a half. Just off the top of my head. 4 minus, did I do that math right off the top of my head? I'm trying to think of too many things right now. So 31 minus, what was it, the 18? 31 minus the 18, that's 30, or 13. 4 divided by 13, let's call it. So it's 30, so that puts it in there. Thanks, Bob. So yeah, so 30, you know, that could, if we're only looking at this for the last 6 months, we could make that work because it's above 30. So you could do that. I'm just not seeing the premiums in here is the only problem with that 16 delta. But this is what I'm talking about, tight bid ask, $70 stock, tight bid ask, 6 cents wide. That's a good market. You can even just double check it by looking at volume and open interest and see that, you know, there's a lot of open interest and a lot of volume on any given day. So you have the opportunity to get in and out of these at any given time. Whereas like if we looked at something like Restoration Hardware, everybody's heard of Restoration Hardware. It has a high implied volatility percent, but look at these markets. They're like 15 cents wide for $30 stock. To get in and out of that, or 20 cents wide. Sometimes they're even wider than that. There is quite a bit of open interest and volume participation in there, but you know, 30 cents wide on the $30 stock is just not something I want to get involved in. So XLE would be a good one, and we can look at that a little further. Somebody else was throwing out Tesla, I think. So Tesla, you know, you have this big spike again. So is that, you know, that was on an earnings event. When is Tesla's earnings? They got to be coming up pretty soon. Yeah, they're actually on the 26th. So we're in this month, they're on the 26th of October, so just inside of that right there. So I would hold off on Tesla just for that reason. And you know, the other thing is even if you put it on now, for one, if the market starts moving towards one of my legs, you know, then my probabilities of being in the money on a big move, which you can see Tesla on earnings has pretty big moves generally. Your probabilities of going into the money increase dramatically. So keep that in mind. So I would probably stay away from Tesla. And, you know, any of these other ones that are up here. We got GDXJ. And up here, I'll show you the GDXJ trade that I had on. So GDXJ, when I put it on, was trading in this trend. And it was looking great until this happened, and it on one day went down and hit basically my break even in one day. And as soon as that happened, I can show you, I rolled them down, and I only have a little bit of time left in them, and I tried to roll these down again to the 40s and collect. I wanted to collect at least 40 cents for it. Never got hit on it. And you can see what I did is I started out with the 40s and the puts, and when they went into the money and hit my break even, I rolled my my calls down dramatically. It was a 52.40 strangle, and I rolled my 52 calls down to the 42 calls and collected another $1. So when I originally set up this strategy, I collected $1, so my break even was 39 to the downside, and you saw on that one day it broke down, hit my break even. That's when I rolled these down from 52 to 42, collected another $1, so that brought my break even down to 38. So I am just slightly above break even on it, even though it looks like on my in my portfolio, it looks like I'm losing money. It's not counting the money I'm collecting, so keep that in mind too. But again, I tried to roll it down again and collect another 40 cents, give me a little bit more wiggle room to the downside. So that's how we stay mechanical. That's how you increase your probabilities of success. And now if I can get this just to rally up in here a little bit more, you know, I'm home free on this trade, and I'll probably look to close it out relatively quickly, especially because I only have 7 days to go. And this is one of the few times, like I said, I was getting ready to close this trade out and it went against me. So, you know, I've had to manage it. But that's life. That's what we do. And that's how we stay mechanical. But by doing that, and, you know, those 52s aren't even on here anymore, but you can see that up here, these are worthless. So there's no sense in having that call on. I mean, some people like to take it off and let it ride, but I like to increase my probabilities of success, and I just roll it down and collect more premium. If you continue to collect more premium, you continue to lower your break even on this, or if it tests you on the other end, you increase your break even to the upside. So stay mechanical that way with these. Do you ever make the straddle unbalanced because of technical analysis or other directional bias? Good question, Keith. I don't usually make my straddles unbalanced. If I've got more of a market direction, I am usually selling calls or selling the puts. Maybe a call spread, depending on my feeling. But if I have a pretty strong opinion about something, then I'm going to do it naked. Now, one thing to note when we were talking about, before I forget, let's look back at what were we just looking at? XOP. XOP to the upside. So if I was looking at doing that, or was it XLE? Is it XLE we were just looking at? To the upside. So, you know, IRAs are only concerned about upside risk, right? So in this regard, if I was looking at doing this as the strategy that was going to be appropriate for the IRA, we'd set it up by selling these because that's as close to the 16 delta. You know, you could go down a little further. I usually, even if these 45 are 64 and a halves, I like to go a lot of times to the whole number, just because there seems to be more participation in those for whatever quirky reason that is. And then sell these, and of course I'd like to collect $1, so let's pretend I collected $1 on this for argument's sake. That's my goal, is to try and collect $1, and I don't really want to go down, although I'm biased to the downside, so I might pick those to get that to $1. So let's just say I did to collect $1, so I'm going to lower that to, and I may very well do that, and it makes it unbalanced, biased to the downside, but I'm biased to the downside anyway, so be happy to do that. All right, so to make this IRA appropriate, what we're going to do is look at the first thing you do, or first thing I do, is go out to the first strike I can only pay a nickel for. So that would be this 81 strike, and I'd hold down the control button, add that. That defines my risk to the upside, right? I'm not going to take that much heat on this strategy. I'm going to be out of it. I'm going to start pulling it when it's basically another rule I look at. So if I've been able to collect $2, if it's $4 against me, because that's twice as much as I've been able to collect, I'm probably looking to either cover that or go inverted. But the likelihood of me holding this out past a one standard deviation move, that's like a 3 standard deviation move, is slim and none, and Slim just left town. So I go to buy that call for a nickel, the first one I can buy for a nickel, and that defines my risk, makes it IRA appropriate. But it does not, and by any stretch of the imagination, really limit your risk. Keep that in mind. We're not really limiting any risk, because that's a bad situation. You know, if it starts moving that fast, I might even just go and look in buying some of the underlying to help protect myself to the upside, especially if I've inverted, it's continued to go against me. That's probably, I'm going to get even more aggressive and buy some underlying. But generally, I'm not going to do that. Okay. Also, do you roll the call side? Yes, I do roll the call side also. If it were going to test me to the downside, I roll the calls down, which is what I was talking about with that GDXJ. That's how I've had to defend that one. And again, I try to roll that into the strangle, or from the strangle into a straddle, which is basically both calls and puts are the same strike today, but it didn't work out, and I didn't think it was really worth, if it comes back, for only 30 cents or 20. I think it was telling me I needed to really go down to like 30 cents, and I was like, it's not really worth it for the commissions and everything else I'm going to have to take to have it be a strangle, a straddle. So I just left it, hoping that I was going to get hit. So I'll have to see on Monday what I'm going to do that. Does that make sense for you guys with how to define that risk? But you're not, I want to make sure you guys understand you are not limiting your risk by picking a strike that is that far out of the money. And Keith, right, yes, I would not want to hold this through earnings. You're right. I would want to be out, because you think about it, the probability of it being right here, me putting this on 20 days before the earnings and it being right there at earnings, 2 hours to go in the day, is pretty slim. If it were, I wouldn't have even held it that long. But just because you can imagine if it moved $1 or $2 in one direction or the other, now my risk of being in the money is very realistic, and it's not worth it. All right, so a couple of them that I was even looking at was, and you guys kind of hit on them with SPY. I actually was looking at SPX because SPX is a bit of a bigger one for people that like to trade the bigger contracts. I mean, if you're doing 10 lots in normal underlyings, then you could even look at 1 lot in the SPX. That would be relatively equivalent for the for that type of situation. If you trade 10 lots in the options, SPX is a good one, and it's above 32%, or it's higher than 32 IV. And we can also look at, it has had some spikes, and it could just start trending back along here. This is kind of a funky little setup right there, so I don't really know how to look at that right now. So Wolf, have you previously done generalized IRA account strategies webinar? No, Rick, but you know what? That is that's a good idea. I should do something like that, because more and more people are even able to trade their 401ks these days, which is a great thing. So I should probably do something like that that's appropriate for IRAs and or people's 401ks. I will look into doing that. Thank you for that. I'm going to write that down real quick. Sorry, IRA webinars. All right. Yeah, I will, definitely. That's a great idea. I appreciate that. And everybody else is saying thank you too. So Rick, good call. All right. So yeah, we'll do that. So let's look at SPX. So like again, if you're used to doing 10 lots or 5 lots in an underlying for option strategies, then you would probably want to do 1 lot or maybe or skip this, because as you can see, these are big boys. on the contracts. But having said that, it does allow you a little bit more wiggle room to the downside, and you're going to collect a lot more for it. So we'd sell the 16 delta, which is 2005. I like that because I think the 2000 marker is a psychological support level without ever even looking at a chart. And then we would pick the 2195 area and sell those as well. And keep in mind, I talked about 10 cents wide. This is a $2,000 underlying, so you're going to have about $1 wide. But if we look at this, I bet you this had a lot of trading volume today alone. 74 contracts. People, and this is what I was talking about. People like to pick these round numbers, even though those are 95s. You can see people like the big round numbers. I'm sure those 205s have some serious. Where was that? 205s probably have some, not as much as I would thought, but the 2000 definitely. So you could even pick that if you really wanted to, but we have $17 of leeway room to the downside on that, and I would not do this as a 10 lot unless you have like $1 million account or something. Say to do something like this with a 1 lot, you would probably want 100,000 or more in your margin account or your IRA. But if you're doing an IRA, you're going to slide out to find the first one that you could buy for a nickel, which, when you get that far out, it gets pretty hard to find it. But, you could define it by buying this in, lowering it by maybe 10 cents, because it's going to probably try and hit you on 10 cents or something like that. But go out here and try and find the one that's for a nickel. These are probably be able to get for a nickel, or maybe even these. But again, you're not going to hold on to this when it goes that far, because that will be painful. All right. Do you try and calculate support and resistance for strikes, or is your delta target good enough? I look at my delta target first off, and if I can go in, if I'm like trying to figure out like, okay, well, should I pick the 195s or the the 2200s, and then I come into this chart and I look at like this, for instance, the 195, or I should say 2195, I'm shortening it, but the 195 is above this. I'd probably pick those 195s, because to get through this is a new high, and that is going to act as a big resistance. You can see it's tweezer tops or double tops there, so that would act as major resistance, right? And then what was the other one? Is that the 200s? So the 200s are, was it the 200s? No, that was the upper end. What was my bid? Bid was oh yeah, it was the 2000. So I know that's a psychological. I don't even have to look at that on the chart. It may not even show up, but that's below here. So I think that would be a pretty good one. And that's a really nice credit. So again, it could go above, make new highs, all the way to, the 2210s before I'd really have to start getting defensive with this. And you're going to collect a lot when you roll down. This is a situation where you would be collecting a lot more, because if we went into the money by that $17 or so, right about there, we could look to be able to collect, another probably $15 or something like that. So to answer your question, Ken, yes, I do look at support and resistance just to kind of, if I'm on an indecision as to what particular strike, I may move it a little bit for that. So I do look at support and resistances for sure. But it is it's a secondary. Okay. Does anybody else have any more questions for me? Those are some great ones. All right. Anyway, so I'll start closing it up then. You know, if you guys have enjoyed this, and I know a lot of people have heard of Strangles and all of these other things, if you've taken anything away from this webinar, for $36, I mean, that's cheaper than a couple hours at the bar or a lunch with your wife. And the only thing that really matters is building that gray matter between those ears, like I talked about. And for $36, that could pay for one bad, if you had one bad trade, that $36 is probably much better spent here, and you probably would learn from your mistake by even just watching these videos and going through everything. So Ken, you were talking about support and resistance. I usually look at market profile a lot for my options. TJ is saying never buy options. I never say never about anything, but I do buy options, but only when push comes to shove. I did that SPX today, or I did the SPX a little while ago, but I do buy options, especially in these types of environments where there's almost no volatility in anything but the earnings. But because we're right back in earnings season, you probably, if you're watching the daily market profiles, if you're watching the daily market commentaries, you will see that I'm going to be very concentrated on doing selling premium, because that's where my bread and butter is, you guys. And that's really something, it's counterintuitive to a lot of people, but that is where your best probabilities are. And if you're continuing laying out money, you're really looking, you're like that home run swinger that is swinging for the fences. And I like to get on base. I like to get on base, and I like to steal bases. So you go for the singles and the doubles, and your batting percentage is going to be a lot higher. If you only hit one home run every, if you hit 20 home runs in a 100 plus game season, then guess what? You didn't do very well. But if I got on base, on a 400 batting average, I did a lot better. So ultimately, I'm going to be more profitable than that home run guy, because the home runs just don't make up for it. Can you explain the defense a little more? Yeah, Chris, I'll go over it again in a minute here in more detail, because a couple other people might. The big game on the Cubs, I know. I watched that last one. That was great. And then, yeah, I'm going to be watching the Cubs for sure. As a matter of fact, I'm wearing my Cubs hat right now, guys. Oh, I just lost a bunch of people. No, I'm kidding. But yeah, so this talks about how to set up your screen, you guys, talking about delta, odds of winning trades. There's so many great things in this, and if you've learned anything from this past video, you're going to learn a lot more. And for $36, like I said, yeah, you can't even take your wife out or wife or husband out to lunch for that. And one bad trade, that $36 will be made up for this. I would say, highly suggest that. How to protect from rising interest rates. We've started seeing some economic data come out. We've heard some Fed governors talk about raising interest rates. If you have a portfolio and you're trading in an IRA, you likely have more than 50% of your portfolio in interest rate sensitive products. And if interest rates increase, it's going to decimate some of that. And it will be painful, especially if you are in interest rate sensitive ETFs. Those guys are going to get crushed when interest rates start rising. Anyway, good one, Rick. I got your joke. And how to figure out options in the dividends. A lot of times those dividends are in the options chain even before they tell you what the dividend is going to be, it's priced in there, and I show you how to find all of that stuff out that I don't have time to do in every one of these. So keep that in mind. If you want to become more consistent or become a real professional trader, this course is what teaches you what we did on the floor and what's not really taught anywhere else. So this is going to be valuable information. There's nothing out there on the web. I mean, I've seen stuff online and nobody really talks about this stuff. So it's going to help you produce consistent winners over time, even if it's just in learning how to defend something like the strangle. A lot of people don't even talk about that. A lot of people just try and cover those, and that is not increasing your probabilities of success. And you know, one good trade on this whole thing is going to easily pay for this many times over. The other thing is you know, you have unlimited access to me via email. If you got, and if I can't explain it all in an email, which I hate to type a ton, but if I need to go into more detail than what I can do in a email, then I would be happy to jump on the phone with you, because I want to see you guys succeed. My idea is the more people out there that are educated and able to trade, it's going to tighten up all those markets. Maybe even in restoration hardware, we'll see better markets in there. So I want you guys to succeed. We don't all have to have the same opinion on market directions to make money. So it'll easily pay for itself. And you also get the daily market commentaries, which is going to be really important to wrap these strategies around the earnings event. So right there in the chat box is a link to that particular offer. It is also, you can also call us at 310-598-6677 or email us at trading@ProTraderStrategies. This is also the link that you can jot down. You can't really copy and paste it. We don't have the link for that, but that is the link for that offer also, how to trade options like the Wolfman. In later webinars, we're going to be drilling down on other option components, how to trade them, when and where I find them appropriate. And just like Rick reached out, I think it was Rich, or Rick reached out and said, hey, do something on IRA appropriate. Those are great ideas and something that I hadn't thought of. So if you guys think of something that we can do better maybe, or a webinar that we could do that would really fit your portfolio or something like that, or you want me to tackle it that you haven't seen, reach out to us at trading@protraderstrategies.com, because I'm sure somebody else has that same thing going through their head. So reach out to us about that, and we will cover that in the future for sure. I want to thank you guys all participating. I really enjoy it, and if you can't take that, take it easy. All right, so I'll go over some of these questions. Some people are like throwing some questions out real quick. What pricing model do you prefer? If you're talking to like Black-Scholes or something like that, I think Black-Scholes is bunk, because it doesn't really tackle theta decay, and it's more for European options. And one of the biggest components that I look at is theta decay. In the SPY trade, when the SPY hits the lower strike, do you roll down to the next one or roll the strikes below? My first thing, okay, so let's look at it as a time frame situation. One thing, if it is getting close, that was my struggle today, was whether or not I didn't really want to collect that only 30 cents by rolling that thing into a strangle. The other opportunity I had, and I was flipping back and forth on it, was rolling those calls out in time. And you can do that and collect some more credit. And then that becomes more of a directional bias to the downside. So I had a real struggle with that, because I am more bullish on gold right now. You know, and things could change, but at this point, I was thinking, you know what, I'm still a little bit more bullish on gold. I think we're going to see a bit of a rebound. So I didn't want to do that right now. You know, on Monday, if we start seeing a breakdown, then I'm probably going to roll those calls out in time and then get out of my puts, and try and tackle that way. So it's a bit of a conundrum there for that question, because if it happens right away, Chris, for instance, I put this trade on in one of these that we were talking about, and in 1 or 2 days, it's down there testing my strike. I'm going to be more aggressive with that within that option cycle that we're talking about by rolling down probably straight to a straddle rather than create a tighter strangle if it happened really fast. But usually I'm starting to be, excuse me, I have a tickle. I'm starting to roll that down and collect more credit when it's at my break even, which is just below those strikes. Because I'm looking at the probabilities, you know, it's a 32% chance of 1 in 3 that I'm going to get hit. Those are pretty good odds that I'm going to get touched on that, or at least tested, you know, test my psyche, if you will. So that's why if it goes in the money and it tests my break even, that's where I look at, all right, that's where I start needing to be more aggressive. Roll out and down, I think I talked about that. Yeah, I could roll out and down maybe to a you know, a longer duration short in that, but I'm going to leave those puts in the month that I'm in. And do you roll the calls down and create a straddle? Yes, I could. My first move is to try and create a really tight strangle, and then my next move is to a straddle or out in time, and then you know, worst case scenario, I will go inverted in some occasions. But a lot of times what I'll look at, rather than going inverted, a lot of times I will look at, if it goes down, having that stock put to me, and then start selling calls against it in longer duration to lower my overall basis on that, which is what happened to me in an earnings trade on target last earnings cycle. I got put that stock, and I've been lowering my cost basis by rolling calls out every single month since then, and I'm very close to break even on that. So I've done that. Same thing happened to me with Twitter. I got put that stock and continued to sell calls against that during that duration until I got to break even. How do you make this IRA friendly? Trevor, I buy the first call that is a nickel. First one I can buy for a nickel, that's the call I'm going to buy. And that makes it IRA friendly. It does not lower your risk though. Even though it looks like it does not really lower your risk. Keep that in mind. As a matter of fact, if you buy that first call for a nickel to make it IRA friendly, it doesn't change your margin requirements on it either, because they're going to ask for a certain amount of margin for it. Please explain the inverted strategy. That's where basically you're selling calls below where you have sold your puts. So you have locked in a loss. So a situation would be like trying to cut, if it was originally like with my my gold, if I have those short 40 puts, right? If I rolled my calls down again, if it went down a little further probably, and I rolled my calls down to the 35 calls, so now I'm short 40 puts and 35 calls, that's inverted because I've locked in a loss. If that market rallies up, I'm losing money on my calls. If it, you know, so it's a no-win situation. But in that, I've probably collected about, you know, $3.50 for that. So if it does come back up and lands in between there, as soon as it hits my break even, I've added my $3.50 to the calls. So when it's trading around $38.50, that's when I'm looking to get out right away. Somewhere between 37 and 38. But I've locked in a loss. I've kind of staffed the bleeding a little bit. Does that make sense? Okay. And then somebody else asked a question earlier on before it rolled off. I'll try and get that. What is the Sorry, trying to look for your question here. Defense a little bit more. Chris, okay, that was Chris that asked that. And I think I answered everybody's questions. Anybody else have anything else real quick before we go? Keeping you guys a little bit longer than normal, but I want to make sure this is all straight in your heads. Have you done a class on using diagonals on stock replacement strategies? Yes, I have done one on diagonals and stock replacement for sure. Trevor, I thought you were around for the, weren't you around for the synthetics? You can check those out. I did real synthetic longs, real synthetic shorts, and then I also did poor man's covered call, poor man covered puts, which is limited risk synthetic. And I've done them on diagonals, and there's a link for you in there. But you guys really should take advantage of this because that is not going to last long, and you can't beat that price. You're getting charged more in commissions on other things than just that. How about credit spreads? I do have strategies on credit spreads, long calls, long puts, long call spreads, long put spreads. Oh, okay. Those are pretty much the stock replacements. Okay, guys, that's all I got for you guys. Oh, one more question just popped up real quick. Is there any way you can make a catalog of your recorded seminars only? I haven't done any seminars. I've done the webinars, but somebody should pop something in there for you for the all the recorded webinars. We are planning on doing some seminars. We just haven't done any lately. And if you follow me on Wolfman's blog, Chris, I talk about some of the other engagements. I do different talk things online, and Pro Trader Strat pushes that out when I'm doing that, and I throw it out on my Twitter whenever I see what I'm going to be doing there. What services do I offer besides the training videos? You have unlimited access to me, Ken. Like, you have a strategy that's gone against you or anything like that, you have unlimited access to me, which is, I think, very valuable. And I also do these other speaking engagements that, if you're following me on Twitter, I throw out there. Will you be covering credit spreads in these Friday classes? I will. I'm going to be doing some more of those. As a matter of fact, next week we're going to be doing long strangles. So that's a, oh, sorry, that's a credit, that's a debit spread. Covering more credit spreads, absolutely. I'm going to be covering the iron condors shortly, and then we'll be moving into some of the other ones. Great, Chris. Thank you. I appreciate it. Thanks, you guys. All right, you guys have a great weekend. Take care.